keeping trading partners on the defensive, and that could well be a drag on future earnings. We're joined by Garnet Anderson, VP of Portfolio Management at Tacita Capital. He's with us in the studio. Garnet, thank you very much indeed.
Good afternoon.
The Bank of Canada minutes indicated that companies are already rethinking investment plans, and that's happening everywhere, it seems.
Well, absolutely. If you're going to build a plant in Ontario, you're going to build a plant in BC or down in Ohio, you're going to be thinking twice about this. We saw it out of the NFIB in terms of small business confidence stateside early this week. That's come off their December high. So I think it's just natural. So not only do you have our governments reacting and going down to Washington and try to figure out how to negotiate a better deal or exemptions, naturally corporations are going to start to pivot and ultimately start to look for other trading routes, if you will.
But that takes so long, doesn't it?
It does, absolutely. That's the whole thing. I mean, thankfully, we've got the LNG coming in on the BC coast, Kitimat sort of thing. At least that's one plank out there.
Yeah.
But it will take years to build out new relationships. And hopefully a bunch of those discussions now are going on both at the governmental level and at the corporate level. It's a little bit awakening call, if you will. We've been very fortunate. We reside right beside the largest consumer and economy market, and it's natural lowest cost deliveries right to our next door neighbor. Why would we not take advantage of that? But it's been going both ways. Let's not pretend it's one-sided. They're not subsidizing our lifestyle and so on and so forth. They want our energy, take that as a surplus going the other way, services. Let's park that to the side. It's been a symbiotic relationship that's going back decades, maybe centuries. And so now we're getting our cages rattled, and so are corporations, and so are households.
Do you think we were complacent as a country? I mean, who could have anticipated somebody like Trump, I suppose?
Well, we saw a little bit with Trump 1.0, and then there was a little bit of a retrenchment, but I think we knew what was coming in to a degree. It's not as if he hid what his intentions were.
No.
I think the challenge, right now we've had bullets that have whizzed past, for all intents and purposes. But the in and the out, we're doing this, we're not doing this, we're doing this, we're not doing this, it keeps everybody on tenterhooks.
Yeah.
And I think that's going to become a challenging part, not just for Canada or Mexico, but I think for really his own, population base.
Yeah.
Again, hiring is important down there. He needs it at a strong employment level. And right now it has been strong. We saw, the jobless claims today looking pretty good. Not much disruption coming out, thankfully out of California, although that certainly did perk up, and just now starting to see the first of the federal employees come through the numbers. But they still have a good, strong economy. And let's be honest, as portfolio managers and investors, and with the U.S. constituting, 66% of the Morgan Stanley All-Country World Index, we want the U.S. economy to do well.
Yeah.
We just don't want them to steamroll us. And we want their market to do well because we benefit from that as international global investors.
You have some stocks on your radar. I'm going to start up with Brookfield. Is that a buy right now, do you think?
Well, it is. It has been, ideally, it's a position that people have been accumulating because that thing has been ripping over the past year. I mean, it's up, 75% over the last 15, 16 months. They did announce, a dividend increase today, but it's not really a yield-oriented product. It really is, I'll say, a conglomerate. It's got, the real estate. We like the real estate because the trough is kind of plateauing, if you will, in terms of property values. We're starting to get some same property net OI increases. That's a positive. We know that renewables has been on its heels for a while. So again, a little bit there, that's a positive, good infrastructure. And then you get all the other stuff over and above that that has good revenue income. So when we put that into our TCIP real asset portfolio, it's been a long-standing position, it's done very well for us. We do have to be mindful about rebalancing every once in a while. We don't want that to start to dominate against something that's had such strong momentum. Usually let that keep on going, but you do have to be cognizant that it will pull back. And in fact, it had pulled back a little bit to the pack, and then obviously up today about 3% on the news that it beat earnings expectations.
The pipelines, Enbridge and TC, are they buys right now?
They would be buys. I think for folks that might wake up, January 1st, 2026 and go, all I earned was the 5 to 6% dividend yield that came off of that, that might constitute a good year. There probably still is 5 to 10% in terms of price movement available, but they're not priced inexpensively at their current EV to EBITDA, their current forward price earnings ratio. They are stretched up to the the top of their 10-year. Now a little bit harder to tell with TC Energy because it rolled off South Bow, so the comparatives are a little bit tougher. But having said that, there's the headwinds there and there's tailwinds there. Headwinds are, to your point, tariffs, okay. But if that happens, the Canadian dollar, they've got a lot of US dollar income that will come back, get converted to Canadian dollars for their financials and EPS calculations. Positive there, it's the drill, baby, drill. So that should lead to more volumes. And it's very hard for the Midwest producer refiners to replace our heavy oil. So they should have some protection going there. And to your point about, I think you used the term hype, buzz, whatever the term was in terms of the whole AI and the build out of the energy
electricity,
for that need, that is, that's helpful for that area. It's not as if their revenues are going to, go up 120% or anything ridiculous, 20% to 120%, but their earnings should continue to grow. Their dividends are expected to grow over the next year and two. And so it's a little bit more of an income, but certainly an area that you want in your portfolio, a little bit of inflation protection.
What about the Canadian banks? Do you like to look at them? I mean, they've got decent dividends.
Well, they certainly have decent dividends. Now, back when they had been really beaten up, those dividends were almost obscene. Good, in a good way.
Sure.
So they've come off from those highs in terms of dividend yields, but they're strong. At the end of the day, they've got an oligopoly. I mean, I don't think anybody's really talking about, and again, the president of the U.S. has obviously lots of power, lots of negotiating leverage. It's common, you don't let us compete in your financial services market. Well, we do have an oligopoly, and they do, spread out across our own border. So will that open up somehow? That would obviously hurt. So the story there is good. If tariffs ended up being punitive, you go back to the Bank of Canada's research back in 2019. If the 25% came in, we're sitting down at -6% GDP, not as bad as COVID, but worse than the other recessions we had. That is going to start to rifle through bad debts into the bank balance sheets. And you can tariffs come and they get permanent or last for more than a day and a half. Are we going to start to see commentary around, bad loans, what's going to happen there? And that usually takes some of the steam out of the bank's march onward.
So you're not wildly keen on the banks
We
right
are comfortable
now?
in our value sleeve. We certainly have banks in our VQM pool. We're comfortable with them. They're an oligopoly. They have the ability to produce revenues. I think if you take a look on a rolling 2-year, 3-year basis, you're going to be comfortable with that holding.